Have you ever wondered what would you do if you get to hear about something that was doing fine before is now on the edge of the end? The situation is not much different for most of the US banks that are now receiving the same predictions of being on the edge of a collapse. Why is that happening and what are the main reasons behind that? Today, we will dive into that. So get ready to know what you should know. Bank collapses have been infrequent in recent years. However, on March 10, the greatest bank collapse in the United States since the global financial crisis occurred in real time, when a major lender to the technology industry fell to a classic bank run. Customers of Silicon Valley Bank were swiftly withdrawing funds from the California-based institution before the US government intervened to seize control. Meanwhile, these banks poured money into long-term bonds whilst interest rates were extremely low. It was a result of a poor risk management and the belief that interest rates would stay low. However, the collapse frightened markets, adding to the agony felt by weaker financial institutions already dealing with the unexpected repercussions of rising interest rates and self-inflicted losses. A few days later, a second US regional bank, Signature Bank, was closed. A third First Republic Bank, or FRC, was pushed up, and the first big danger to an international financial institution since 2008. Credit Suisse was prevented when it was taken over by UBS. However, the relative serenity has just been regained as a result of massive amounts of emergency liquidity provided by lenders of last resort, central banks, and a few of the industry's most powerful players. Markets are still tense, and the current situation of indices used as of US and European bank shares have fallen 20% and 13% respectively since the conclusion of trade last Wednesday. The history of previous bank failures. The last time a significant banking crisis occurred, it was followed by a deluge of bank closures after banks announced billions of dollars in subprime mortgages losses in late 2007. Public opinion began to shift. As losses piled up in 2008, it caused an upsurge on shadow banks, which aren't supervised like banks, but fulfill comparable functions. Banks and anonymous financial institutions were using seized mortgages as security at the time. It was also impossible to estimate the worth of these things at the time. The financial crisis triggered an influx of bank failures. But what's actually just happened now? Let's take a look. On March 10th, SVB was taken over by the Federal Deposit Insurance Corporation, or FDIC, of the United States government. It was the largest financial failure in the United States since Washington Mutual in 2008. The wheels fell off 48 hours before the bank faced a multi-billion-dollar loss, paying out US government bonds to compensate investors. It attempted, but failed, to sell shares in order to strengthen its finances. This sparked the panic that ultimately led to its demise. Later, the FDIC closed down Signature Bank following a deposit run by clients alarmed by SVB's demise. Both banks had an exceptionally high proportion of unsecured deposits used to support their operations. Soon after this, following a 30% drop in Credit Suisse, or CS shares, Swiss authorities declared a safety net for the country's second-largest bank. It alleviated the initial market fear, but the worldwide player is far from out of the traps. Investors and consumers are concerned that it has a realistic plan to avert the business's long-term downturn. Users withdrew money, putting First Republic Bank on the verge of failure. U.S. Treasury Secretary Janet Yellen and Jamie Dimon, CEO of America's largest bank, met in Washington to devise strategies for a private sector bailout. As a result, an agreement was reached with an association of American creditors to transfer tens of billions of dollars in cash into the First Republic in order to stop the financial crisis. In a sudden aid agreement intended at calming financial market fear, Switzerland's largest bank, UBS, decided to purchase its troubled rival Credit Suisse. But exactly how much has the US government spent on this? So currently, more than $400 billion in immediate support has been provided. The U.S. Federal Reserve is on the line for $140 billion for insuring each deposit at Silicon Valley Bank and Signature Bank. Then, there's the $54 billion in emergency funding granted by Swiss National Bank to Credit Suisse, and the 209 billion Swiss francs or $225 billion in loans backed by the Swiss state and security from any losses given to UBS. Last week, the U.S. Federal Reserve also committed to record levels of lending to other banks. In recent days, banks borrowed roughly $153 billion from the Federal Reserve, breaking the previous high of $112 billion established during the 2008 financial crisis. Banks also borrowed roughly $12 billion in loans through the Fed's new urgent financing program, which was formed at the beginning of the week to avert future bank failures. The Federal Reserve's overall loans to the banking sector of $318 billion is roughly half of what was given during the worldwide economic downturn. However, the U.S. chief economist at JP Morgan, Michael Ferroli, has said that this is still a huge number if we compare it with the earlier times. He said it's just like the half-empty glass situation where the banks are still in need of huge sums of money, while the half-full glass situation shows that the system is working under current scenarios as it's supposed to. The banking sector has also contributed billions of dollars. JP Morgan Chase, Bank of America, and Citigroup are just a few of the 11 creditors, giving the $30 billion capital infusion to boost First Republic Bank's trust. On the other hand, HSBC is said to have committed over $2 billion to SVB's UK business, which it purchased for £1 on Sunday. With the ongoing situation of the banks, is the money inside safe? Customers are concerned with the current scenarios of most of the US banks and raising several questions about their money, whether it's a safe plan to keep their money in the banks or not. Well, to answer that question, if you have under $250,000 in an FDIC-insured account in the US bank, you probably have nothing to be worried about. A joint account has insurance for up to $500,000. Several European nations have comparable programs. In Switzerland, each depositor is insured for a maximum of 100,000 Swiss francs or $108,000. Customers of bankrupt European Union banks have been offered a refund of €100,000 or $105,431 based on their savings. Joint account holders are eligible for a total settlement of €200,000 or $210,956. The users in the United Kingdom may get back an amount up to £85,000 or $102,484 if their bank collapses. For joint accounts, the amount is increasing up to £170,000 or $204,967. Now, you might be thinking, what would be the loan criteria and will all of this make the loans harder to get from the banks? The quick answer is yes. When banks are stressed, they are going to pay considerably more attention to the dependability of consumers, whether they are businesses searching for loans or house purchasers looking for mortgages. In confirmation before the Senate Finance Committee on Thursday, U.S. Treasury Secretary Janet Yellen stated that when banks are in such a condition, it is more likely to happen that they will not lend much. She also stated that it is very much clear that the credit is not much available in the banks and is becoming expensive. The European Central Bank's president, Christine Lagarde, informed media Thursday that persistently high financial concerns could further restrict credit circumstances, which have been already deteriorating due to increasing interest rates. Is an economic downturn more likely to occur as a result of this? The answer is yes again. Yellen also told the Senate committee that this might develop into a source with considerable adverse economic risk. According to Goldman Sachs, rising pressure on the banking industry has increased the likelihood of an economic downturn in the U.S. over the course of the coming year. The banks now forecast that the American economy will face a downturn within 1 year, which was 25% before the banking sector collapse began. China's economy is similarly stuttering. despite a surge in activity following the abrupt conclusion of severe COVID clamping restrictions early this year. In an unexpected move Friday, the Chinese central bank reduced the amount of funds needed of the country's bankers in reserve in an effort to keep currency moving through the economy. Seems like the banks in the US market are on the verge of collapsing, and as the experts are indicating, 2023 could be the year for global banking crisis. What are your thoughts on that? Let us know in the comment section down below. If you like this video, then do like and share this video. Also, don't forget to subscribe to the channel and press the bell icon so you get the latest business and market updates right in time. Thanks for watching, and we'll see you in the next video.